All right, this is being recorded. One thing I do say at the beginning of all these webinars is watch this again shortly thereafter, especially if you're new to this strategy. And I have a lot of particular rules that I have around this one, and it does make it very difficult to sometimes implement this strategy because it doesn't fall in line with those rules. And the reason why I have pretty strict rules with this one is because of the low probability of success with this one. I'm trying to set it up so that you have a higher probability of success. So make sure you follow these rules, jot them down. If you don't get a chance to do it on the first time, do that on the second time. If you're sitting there writing notes in the first one, you probably will miss some of the nuances with this. So watch it again relatively shortly after. It takes me a little while to convert this recording to get it out to you guys, but watch it again relatively soon after. Yes, everything I do with these webinars applies to futures as well, Stefan. All right, so this is Option Workshop. We're going to be doing a series here on butterflies. This one particular, or these next two actually, are going to be on the short butterfly. So keep your eyes out for these. I'm going to be showing you different ways to even set up a butterfly down the road as well, not just the atypical butterfly. All right, so my name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started out trading in college with some money I had earned and with a psychology degree, and decided that, you know what, I'm going to switch my psychology degree over to finance. And upon graduating, moved up to Chicago to work at the Board of Trade, and started trading futures and options ever since. I actually started trading options in college, but around stocks for the most part. So I've been trading just about everything. In that time, I've traded stocks, financial futures, commodities, commodity futures, currencies, and options on all of these products in all market conditions. Got to go over a real quick disclaimer. It says, any opinions, news, research, or analysis or other information provided by ProTrader Strategies and associates or employees is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. One thing is, for one, the SEC is really big on this, and one is making sure we are doing our fiduciary responsibility. And one of those things is if I don't know your risk parameters, I don't know what's in your portfolios, I can't possibly tell you what is a good stock to buy or sell or a strategy to wrap around that, because I don't know your risk parameters. I don't know what's in your portfolios, and these things could be counterintuitive to what you are already doing. So take what we're teaching you in here and implement it into your portfolios in your own way. We're here to teach you how to swim. We're not here to swim for you. And if somebody out there is just always shooting out there, you know, you got to buy or sell this stock, that's just not a very good fiduciary. Anyway, the bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. One other thing, you can follow us on Twitter. I'm at Wolfman's blog, and you can follow ProTrader Strategies at ProTrader Strat. ProTrader Strategies throws out a lot of good stuff on different webinars and stuff like that we're holding, and different deals that might be had, and some good trader advice. I, on the other hand, will tweet out some of my trades and talk about the markets here and there. So you can follow us all there. That earnings season, I usually tweet out my earnings season trades because I do these daily market commentaries, and I do the trades for earnings usually in the afternoon, and trying to get that out to you guys. I don't always tell exactly what my exact strikes are, but if you've watched the webinars and stuff like that, you know my methodology and know exactly where I'm going with those. So it should be pretty easy to figure out. And like I said, this is going to be the short call butterfly. So short butterfly series, and this one in particular is going to be on the short call butterfly. So what's our market assumption with this? We need a big move one of the things with this isn't one of my favorite, go-to strategies necessarily, but at the end of the day, when the market is setting up for this, is the time to do it. Now, one thing I usually like to look at is when the market's pretty much trading sideways or it's stuck in a tight range horizontally. That's usually a pretty good time. The longer duration that it's been stuck in that, it's like a rubber band, the old airplanes where you could hook up a rubber band and the propeller and you twist that propeller and they just keep getting wound tighter and tighter and tighter, and the tighter you round it, when you let go, the faster it spun out. That's the same thing with markets. They build up this pent up energy in a sense, where the more it gets tighter and tighter in a range sideways, the more pent up energy is built up into those, and you'll get that snap in one way or the other. So that's what we're kind of looking for. It doesn't always work out that way. Ultimately, what we want to do is set this strategy up for success, and I'll show you how some of those rules are around that here in a minute. Some of you guys, if you aren't familiar with the strategy, basically we're selling an in-the-money call, buying two at-the-money calls, or the ones that are closest to the at-the-money calls. If we're going to opt one way or the other, we're going to maybe just opt for that one that is just slightly out of the money, but for all intents and purposes, it's the closest to at the money, and then sell one out of the money call. Well, one thing to keep in mind with this is really all we're doing is a short call spread smashed together with a long call spread. So basically, we are combining two call spreads into one, with the long calls being the same strike. Are you talking about a squeeze like i.e. Bollinger Band or Keltner channel? Absolutely, Trevor. I don't really use those Bollinger Bands or Keltner channels anymore necessarily, just because I've used them in the past, but I know, and after a long time of looking at those Bollinger Bands, as the longer it's kind of been trading in a range, it will start to tighten up, and that's the theory behind that all. Is it's the same idea. Is when Bollinger Bands tighten up, it's the same thing. It's like that pent up energy. They know that the Bollinger Bands are starting to spread out. That's when the snap happens in a sense. But you can, over time, we'll start to pick up on that as well. And Bollinger Bands have a tendency to be a little bit behind that move in a sense too. So it is what it is. All right, so keys to success: picking the right underlying. This is the utmost important in its sense with any of these strategies that I talk about. You guys know that this is probably the first slide I go to, is picking the right underlying, because we don't want to even start to think about a strategy or trading something that isn't the right underlying. And what is the right underlying? It is, because we're talking about options and you're looking in the options chain, you're looking at those strikes that are just out of the money on either side of the calls and puts, and if that bid ask is within 10 cents for a stock that's, I'm speaking about a stock that's a $100 stock or less for the most part, any stock that's $100 or less, the bid ask on those needs to be inside of 10 cents. The reason being is that shows you there's a lot of participation in there. There's a lot of open interest and volume. Whereas if it's 10, 15, 25 cents or more, then there's not a lot of participation in there, and the cost of getting in and getting out is really going to eat into your yield, especially over time. So make sure it's a tight bid ask. Another thing everybody always is asking, what about the 300 plus or more stocks? One thing to keep in mind is on those higher price stocks, price line is a little bit wider and it doesn't really fit the mold necessarily, but $300 stock or more, just kind of move the decimal point 3 ticks to the left, and that's kind of how wide it should be. So in that example, a $300 stock, moving it 3 ticks to the left, you get a 30-cent bid ask in a sense. So that's a rule of thumb. Those higher flyers, even Priceline, and those, it's a little bit wider than that, but there's a lot of people in there waiting in the weeds, as we used to call it, on the floor. They're going to give you a little bit wider bid ask, but there's enough participation in there that you shouldn't have to necessarily go mid-market on those. So just start inching your trades down towards the mid-market. Start above or below that by, depending on if you want to buy it, start below that mid-price and ratchet it up. Trevor's asking, so if the market is squeezing, how would you determine which way price will break? That's the beauty in the short call butterfly, is this is the situation where, you know, there's technical analysis out there, and these people will tell you, hey, you know, this is going to rally, it's ready for the breakout, or it's you know, ready for, you know, the sell-off to happen. At the end of the day, probabilities are stock has got a 50% chance moving up and 50% chance moving down. So again, we're still stuck in that conundrum. Which way is it going to go? Well, with this strategy, we don't care. We just want it to break out. We want it to snap. We don't care if it goes up. We don't care if it goes down. I mean, obviously, with the call, it's actually a little counterintuitive because you have that in the money call. You'd like it actually to break below that in the money call, just so you don't have assignment risk. That would be your only real worry on that kind of situation. You know, and that's really only going to happen the closer you get to the expiration, which I'm usually not taking this into expiration. I'll talk about that a little bit later. But, you know, if anything, to get away from that only risk of assignment, you know, you maybe want this one to break lower outside that lower band. But at the end of the day, we really don't care. We want it to just snap quickly, and we don't really have a market assumption with this. We just have a feeling it's due for a breakout, and maybe with the Bollinger Bands or something like that, or you think maybe there's going to be some news coming out where it's going to make that snap. That's what we're looking for. All right, so picking the right strikes. Some people will talk about this short call butterfly where you're just doing the at the money calls that you're buying and then selling one strike in the money and one strike out of the money. That's not how I set this up. The way to pick these strikes is really to make sure that when you're getting a credit for this, because you're going to be getting a credit for this strategy, that you at least get as close to 50% the width of those legs in credit. So for instance, if we were doing a $50 underlying, we would be buying the $50 calls, and then maybe if we went $5 out of the money, we'd be selling the 45 calls and then selling the 55 calls. We would want to collect $2.50 for that strategy, because then what we're trying to do with this strategy is risk one to make one, and that's pretty good probability of success with this. And one thing you can do with this strategy, and I've seen it happen many times, like trying to search for the right strategy, is you could actually be paying a debit for this spread. And if that is the case, you basically set yourself up for an immediate loss. There's absolutely no way to make money on this. You could even set this strategy up for no credit, and again, your risk would be whatever the width of the strike is, and there's no chance to make money, because with this strategy, our max profit is that premium received. So we want to try and set this up for success. It's a little bit more difficult sometimes with the calls than it would be with the puts to get that 50%, but that's what we're looking for. And if in some cases, you might be able to even collect more than 50% of the width of those strikes, and that is the best case scenario. That's what we're looking for, trying to collect as much as we can, but our rule of thumb is to try and collect right around 50% the width of those strikes to increase our probability of success. Collect 50% or more the width of those strikes. So in another case, yeah, if it was $1 wide, it would be trying to collect at least 50 cents. But I find the wheelhouse on this is picking about $5 wide strikes for the most part is the easiest way to get to that type of credit received. All right, does that make sense? And sometimes I'll let the platform with this set this up. You know, a lot of platforms have it where you can click on, you know, call spreads or whatever and do the butterflies just to give yourself a ballpark figure as to which ones might work out. But it doesn't always, because I like to go a little bit wider than the defaults that they have on the platform. So you can look at it for a ballpark and then kind of play around with it, because a lot of them you can tell right away are not going to work out. Is this strategy IRA friendly? Absolutely it is, because it's a defined risk strategy. Yes, we are selling further out calls, but because it is basically two call spreads put together, it's defined risk. So you will not have unlimited loss. We will immediately know going into this strategy what our max profit is, what our max loss is, and then here in a minute I'm going to be talking about when we look to exit this strategy. Because again, like I said, when we're collecting 50% the width of the strikes, it really makes this strategy a 50-50 kind of scenario. It's a low probability strategy. So in that, we're going to be looking to collect slightly less than, well, we're going to be collecting less than the max possible. Picking the right duration for this strategy, somewhere between, again, because we're collecting a credit, I like to go somewhere right around the 45-day area. The reason being is you get the massive decay in here. Some people like to go a little bit further out. I don't really have a problem with that. The only issue with that is your wings need to be even a little bit further out than that would be. So then I would really necessarily always be comfortable with. So sometimes it does work out where you will be able to do that, but for the most part, I find that 45 days to 35 days is the nice wheelhouse to be in for this strategy. And picking the right environment. When I talk about environment, I'm talking about, you know, for one, with this strategy, we would, you know, the perfect scenario would be having it go sideways and then all the other rules fit into line, but it doesn't always work that way. It could be a trending market, so that works as well. But usually when I'm talking about environment, I'm talking about implied volatility, and implied volatility percent to be particular. For this strategy, the best case scenario is where I usually start is something that has an IV percent of somewhere between 15 and 30. You know, usually when I'm doing credit spreads, it usually needs to be above 50 for other webinars if you've watched those. This one's a little bit different. I find that right between 15 and 30 is the nice wheelhouse to be in. If it's too low, it really makes it difficult to risk one to make one. So it's kind of like that nice medium. So and if it's too high, then you know you have a tendency to have really wide wings. I'd like to see the wings be a little bit as tight as you can get is the best. Is, you know, the tighter the better. If you can collect that 50% width, then that's the best case scenario. But you know, we want to be careful about getting our wings too wide in order to achieve the 50% width of the strikes. And knowing our exit strategy before we enter the trade, this is rule of thumb. You know, this is how you become mechanical, rather than going into a trade and start wondering, you know, well, should I get out now? Should I hold on to this? If you know your exit strategy before you enter that trade, you will be mechanical. If you know how to be mechanical, you take the emotion out of trading. And if you can take the emotion out of trading, you will be much better. I can guarantee it. The cool cucumbers, if you will, are the ones who have built a strategy around knowing what they want to risk and what they want to have as reward. And with this, because I said it's a lower probability trade, we're going to be looking to take somewhere between 25 and probably 35% of max profit on this. So in that example where I was talking about, we're going to be looking at $5 wide strikes. We're going to try and collect about $2.50. That means we would want to make about 65 cents on this trade. So that being said, it would go down to, like $1.85. If I could buy it back for $1.85, that's where I would be looking to get out of this. So 65 cent decrease in what the original credit I received was. Does that make sense for everybody? Trevor, no, you will not have unlimited loss. So I'll go over that here in a minute. I just want to make sure everybody understands. We're looking that if we got a credit of $2.50, that is our max profit. Our max profit is the credit received. So if we take 25% of what that max profit is, that's right around 65 cents. So you would subtract that 65 cents from what your original credit was, and that puts you right around $1.85 to buy it back. So we sold it at $2.50, we'd buy it back at about $1.85. All right, so our max loss on this trade is the out of the money call minus the at the money call, or those two that we buy. So that's the call we sold minus the calls we bought minus that premium received. So in that original example I gave you where the stock is trading at 50, if we sold the 55 call, now you could do this with the in the money call also, yes, but it's going to be the same because we're the same distance away on either side. So the out of the money call, which would have been those 55 calls, minus the 50 calls, which is at the money, the ones we bought, that's $5, right? Minus the premium received, in that example I was talking about, is $2.50. That is our max loss if we collected the $2.50. Now, there's scenarios where, remember I told you, you might do this for a debit. Think about putting that debit in this scenario. That's going to create an immediate loss. If you did it for nothing, if you did it for zero credit or a penny, let's say we did it for 25-cent credit, just for math purposes, to make this a little bit more realistic. Our max profit is that premium we received, 25 cents. Our max loss is that 55 call minus the 50 call minus the premium received, which is 25 cents. Our max loss is now $4.75. That is not a good risk reward, right? We're collecting 25 cents to lose $4.75. That's why we have to stick with that rule of building this out. And like I said, it isn't an easy one to find a underlying that fits these rules, but one of the few things you can do to set yourself up for success is order entry, and that's where you get into the trade. That's the most important thing to increase your probabilities of success, and in that we need to collect at least 50% the width of the strikes. So does that make sense on how you see where your max loss is? It's a defined risk strategy because we bought an at the money call, which would limit our profitability to the upside, and because we sold an in the money call, we have that other buy side call to offset the other short call that's in the money. All right, so with this we are going to have two break evens though. So because we have two different calls, right? We have a break even to the upside on this strategy. We have a break even to the downside. Our break even to the downside is our break even to the upside, I should start with that one, is that out of the money call minus that premium we receive. So our break even on this trade that we're hypothetically talking about with the short 45 call, the long 250 calls, and the short 55 call, it's that 55 call minus that premium received. So it brings it down to $52.50. That is where our break even is. And then on the downside, that in the money call, that was the 45 call plus the $2.50 puts us at our break even to the downside at $47.50. Okay, so keep that in mind. You have two break evens. It can go in either direction. So we want it to make that pop to at least our break even on this. And again, we're only looking to take about 25 to 35%-ish of our max profit potential on this. All right, so this is usually where I go into the platform and start throwing out. Can everybody see this pretty good? The platform. So I find that everybody probably learns this the best when you guys are participating and throw out some stocks. I have a couple that are vetted. Like I said, this is a very difficult one to kind of set up because not all the stocks are created equal, and option pricing is dynamic. So it does make it difficult to sometimes find some good strategies, especially with the calls. Puts have a tendency to have some premium pumped in there, and it makes it a little easier sometimes. But the calls, we can find a couple examples that will work out. So throw it out in the questions box. That's how we will communicate back and forth in a sense, or at least you guys can communicate with me. Shady, I guess I missed your question. Trade futures, intraday scalping, using vertical debit, one strike and the money, is this valuable? Shady, throw that one out to me at the end. So after we kind of go over everything, just because I don't want to confuse everybody right now with that, but we can talk about that in a minute. All right, so Microsoft, first one off the bat. So, and one thing we also need to be aware of with these is earnings and dividends. So one thing I want to talk about with dividends, looks like they're going to have earnings very soon. And you can put this strategy around an earnings trade, but I would wait 1 or 2 days before the earnings in order to do this. And that would only be on the expectation you thought there was going to be a big move, and that move would be outside of what the market maker move is, or what the market has predicted that move to be. So you would need a much bigger move than that in order to be successful with this strategy. So keep that in mind. Another thing to keep in mind on knowing our exit strategy before entering the trade is that if we have this directionality correct, right, where the market is rallied up and it's testing our short call to the upside. So in a sense, we have that short call that's deep in the money now. The deeper in the money those short calls are, the higher likelihood there is of assignment risk. So in that, the reason why there's a higher assignment risk is somebody might want to take the stock just to collect those dividends that are coming up. And the other thing is it's going to lower the price of the stock by that dividend, and that could make this strategy get out of kilter. So in knowing your exit strategy, if you see that you're entering into that ex-dividend date, it's probably best to cover that trade, even if it's not 25% of your max profit potential. Cover it for whatever profit you have in that already, and just move on with it. It's not worth going into that and risking good money in a sense. Never, if you're up a profit going into that, it's not risk all of that headache of getting assigned and having to get out of it and and or reassign somebody with your calls, and it's just not really worth it. So stay away from that scenario, and you'll be better off. Save you a lot of commissions. All right, so keep that in mind. So we need to be wary of earnings in this particular one. when's Microsoft's earnings? Do you happen to know offhand? It doesn't show me on this platform here. So we got earnings coming up on the 26th of January, which is just after expiration of the January contract, which is only a few days away. So I'd probably stay away from this. You know, their earnings are right here, so it's right lockstep. We want to have this month be clean, which is going to be difficult because we're just heading out of some earnings, I think, and heading right into the new earnings season, which is beautiful. So yeah, 126. So William, James, if you guys are thinking about doing this one, I would hold off until like the 24th or 25th, and that would only be if you thought it was going to be outside of that market maker move, which, you know, this would have been a move outside of the market maker move for sure. I'm guessing they didn't have that big of a expectation of earnings, but you can see, you know, on this, if you do this around earnings, you don't know which way it's going to snap. If you see a stock that has a tendency to really make big moves on their earnings, whether it's up or down, you don't care as long as it makes that move, then you could put this strategy around something like that. But again, you usually have pretty high implied volatility around that type of event. So your wings are going to be pretty wide. So just make sure you feel comfortable with that type of move. Okay. All right. So somebody else throw out Goldman Sachs. Oops, sorry guys. Goldman Sachs. And we'll do Netflix here in a second. So let's look at Goldman Sachs. One thing to check out is their earnings. Oh, they got to have earnings coming up too also. I'm going to turn that sound down so you guys don't have to hear that when I do that. I have a tendency to over hit that. Oh, they got earnings coming out. So, I mean, they've got low implied volatility compared to what they normally have for earnings. They have earnings out on the 18th. So this would be like Monday. So sometime next week, I mean, if you thought Goldman Sachs was going to do it, I mean, this is what I'm talking about. This would be the perfect case scenario had they not been heading right into earnings, where you get, this is what I'm talking about. This is where it's gotten real tight, you know. Anytime you see like these tight things, you get these snap moves and boom, you know, it comes out of the blue. So this to me is like this kind of thing that I really like to look for this kind of strategy, where it's gotten tight, complacent, it's ready for a snap. So, you know, that would be perfect if they didn't have earnings coming up. So probably, as you can see, they have low implied volatility. It's right in that wheelhouse. I mean, everything else is working out really nice for this strategy. Might even be something I look at for an earnings trade on this one, because it's got really low implied volatility. Everything seems hunky-dory, if you will, in that it's at historical highs, so you could see a lot of profit taking, even if they beat earnings on that. So that might be something I'd look at for an earnings trade next week. So keep your eye out for that on the daily market commentaries and Twitter. So I'm going to actually write that down. Goldman Sachs earnings. All right. So Netflix. Let's look at Netflix. High price stock, so also on the 18th. So, well, let's just look at it, see what their IV is for it. So it's got a 43%. It's a little bit higher than normal. You know, for earnings, if I were going to sell a strangle around this, which is one of my favorite strategies to do for earnings, or an iron condor, then I need that to be pretty high, and that's not fitting that bill. So again, this might be something where the market's not really predicting something like that. And of course, I would probably go to a little bit shorter window. I might even do those 7-day January ones for this. But let's just see if it would work out anyway, just to give an example going. So it's a $130 stock, so we're going to be at least $5 wide on this one. And so I want to do 2 of those. I'm not going to do it as a 10 lot necessarily, but so wait, 133, so 135. So this is, you know, one of those situations where it feels like we're kind of right in between. You know, the thing I usually do is will opt for the one that is just out of the money. The reason being is then I can sell one that's in the money. It'd probably go maybe $10 wide on this one that's in the money then, and that makes it a little bit easier to get to that. So we did $10 wide and a $2. We're risking 2 to lose 8. That would not work. So let's just look at it a little bit tighter and play around with this. You know, that's, like I said, the only thing you can do is control what you do at order entry. It's $5 wide. We're only getting 50 cents. I'd probably kick that to the curb for sure. And it definitely won't work if I do the ones that are in the money. Just don't see it happening. It's just as bad. So it's not going to work there. So we just move on. It's not even close. You know, I mean, I might put it on a short list if it was like $2.25 or something like that. That might be where I would start considering it if I couldn't find something else out. Pepsi. Let's look at Pepsi. Just make sure, let's delete this. Look at the chart just to see. They had earnings. They got to have earnings coming up too. Earnings coming up fast. Yeah, so they have earnings coming up on the 9th of February. It's pretty close, but we want to get something that has had earnings pretty near to us. It's I guess if Wells Fargo is probably going to be okay. So they just had their earnings. So that's good. Today. I missed it. Darn it. So earnings. So they came in line with expectations for the most part. Volatility's come out a little bit, so might be something we could you use the analyze tab for the butterflies? Yeah, I will here in a second. Bank of America just had earnings. So let's just look at this one real quick so we can throw it up on the analyze tab. So $3. This might be one of those ones that ends up being a debit. So let's look. See, look at that. Oh no, didn't work out. So what did I get? So 74-cent credit. So we'll do this to look at it just as an example. And let me make this so it's a little bit easier to discern. So as you can see here, we're risking, you know, but so it's, what do we got, $2.50 wide? Yeah, we're risking $125 only to make 75. So that's just too much of a risk reward, as you can see. I mean, just doesn't make sense to do something like that. So I wouldn't necessarily do that one. Let's I do that 55 as close as we get. Yeah. So that one's not going to work for me. Another one we could look at is what was the one I was going to look at? I think it was Lulu. We'll look at Lulu. I have a position on in Lulu, just so you know, and I'm not trying to get you to jump off a cliff with me in there. Happy to say, if you guys watch the daily market commentaries, that earnings trade for Lulu, I finally got to a scratch after a lot of being mechanical. This is a extra trade that I put on there that isn't associated to that one, but the trade that I had on for that, I stayed mechanical with it and played around with it and got it to a scratch. So that was an exciting couple of weeks or months actually. So we're going to be looking at the let's see, the 60, that's as close as we get really. I get 2 of those in there, so we're going to buy 2 of those. Hold on, let me do this again. 7.5, so buy 2 of those. So one that's just out of it. This is where I usually start out, is the one that's just out, looking at it. No, that doesn't work, so we could go a little bit further out in either direction. So we're going to go to the half strike, which is going to be the 2.5s, and then the half strike to the upside, the 2.5s there. See how that works out. So we're at $5 wide, only $1.50. That one's not going to work for that one. Yeah, that one's not going to work. So, anybody else have anyone? Deere, you want to look at? Oh, Bank of America, you want me to look at? I forgot. So, BAC, I forgot about that one. Let's look at Bank of America. They just, like you said, had earnings, so that's good. It's a pretty tight market. We could expect them. Higher interest rates is good for the banks, so we could expect that to have a big move, especially if they start talking about increasing rates at a more rapid pace. So, you know, it's a lower dollar stock, so I'm going to probably go 3 ticks wide on this. I'm not probably going to go 5 ticks wide on it. Again, I want to be as tight as I can. So $3, it's $3 wide, $1.62. That meets the rules. Now, one thing, we'd like to go tighter if we could. So let's just see what happens when we go just slightly tighter and see if it still fits the rules. We're at $2 wide. We're only getting 81 cents, so we'd probably have to opt for that one that is a little bit wider to increase our probabilities of success, and it increases our, you know, another thing you can do is even look at the break even. So again, just to go over it, our break evens on this is going to be when it's trading, well, I'm going to have to do crazy math right now. So at 24.40, let's just call it, and then to the upside, it's going to be at 21.62. So to the upside and the downside. And excuse me if I did that math in my head slightly incorrectly, but let's look at this as the Analyze tab. Let's analyze it again. So as you can see, this is what we were one thing I forgot to mention is you can see it's defined risk, right? We can't lose any more. If it stays pinned right here, that's where our max loss is. As soon as it trades, you know, to the downside at 21.62 to the downside, that's where our break even is. You know, our max profit is achieved when it gets below this $20 strike. Again, to the upside, our max profit is going to be at 28.40 is what I said, 28.38 to the upside, and then again, our max profit's achieved when it goes above that short strike. So that's what we're looking for. And it does have to move outside of 1 standard deviation in order to achieve that. OM, did you do that math in your head? How do you determine the width of any spreads? So the width of this one, the real thing is I'd like to go for, you know, especially on the $100 stocks, about $5 wide. Anything below 50, I start looking at around $2 to $3 is usually the wheelhouse on this type of strategy. That's just from years of doing it. You know, just like with this $20 stock, this $3 is the one that usually is going to be the one that makes it. Actually, if it had half tick markets, it probably would have been really close to a $2.50 wide to fit the bill on this one. So in this case, we're collecting slightly more than 50% the width of the strikes, which means that we've increased our probability of success, right? Another thing to look at with this trade is you know, this is why it's such a low probability trade when I was talking about it, is in order to get the full amount on this, you know, right at the end of expiration, which I don't like to take into those kind of expiration just because it increases your likelihood of getting assigned on those deep in the money ones. But in order for Bank of America to trade $26, the probabilities of that happening and staying there is only about a 6% chance. That's pretty low, right? I mean, a 6% chance of Bank of America to get up and trade and stay above 26 at expiration. It's about a 10%, a little bit better than a 10% chance of the market coming up and testing that. And that's why when we've beaten that probability, we get up there, that's, you know, a 90% chance is not going to happen, a 10% chance it is. That's why we want to cover it for a little bit less. It takes a long time for these things to really get that max profit. I mean, you have to have the stars aligned and everything else, and the horseshoe. So take a little bit less, because you know your probabilities of success in this are low. Therefore, take a little bit less credit than what we would normally do with this strategy. So this is like a strangle with, yes, you could, you know, just by the sheer look of it, it's like a long straddle in a sense, because if you look at it, on the Analyze tab, that would look like a long straddle. It does look like it's flat right there, but it's really a point. Should be a point. Does that make sense? So it's, you know, and in a sense that would be like a long iron butterfly. Iron butterfly, but that's with the calls and the puts. So, and I don't usually do long iron butterflies for the reason that they are, you know, a high likelihood of not working out, high probability of it not working out. And the reason why I would do this over the long iron butterfly is you're getting a credit for this. So, you know, with the long iron butterfly, you're going to be paying a debit. So that's why this one's better than that option. And if you ever noticed, I haven't done a webinar on a long iron butterfly, and the reason why is because I want to act like it doesn't exist. But with this one, it's the same risk parameter, but you're getting a credit. So that helps you increase your probabilities of success a little bit that way. Okay, so here, I missed one. What was the one? Oh, deer. So let's go to deer. Again, I have position on, so I'm not trying to get you guys to do anything crazy. All right, so it's last traded 105 something or other, so this is the closest one. So let's look to buy this, and deer usually even has better markets than this. This looks like they're a little bit wide right now, but there's a lot of participation in there. I mean, here's the other way to look at it is volume and open interest. You can see there's a lot of open interest in here. Pretty good volume. It's not the best, but I would like to see this inside of 10 cents, or at least 10 cents. But for educational purposes only, let's look at it and then go $5 wide, because it's about $100 stock. To the upside, we're going to be doing the 10s. So $5 wide, set that all up right. We're only getting $1. So we're risking almost $4 to make $1. That doesn't work. What is the difference then credit spreads in this butterfly? This so a regular butterfly, in this case, the short call butterfly, different than the iron butterfly, which would be the long iron butterfly. You are buying a call and a put at the same strike rather than buying two calls with the butterfly. With the iron butterfly, you're buying a call and a put, and then defining that, or limiting that risk. Does that make sense? That's the difference between just a regular butterfly and an iron butterfly. All right, so before we have to, let me go through one that I saw was pretty good, and it was in Oracle. So this, I mean, going through and vetting a couple of them, I came up with Target was one, also was this 65, 70, 75 in February, and that one came out really close to $2.50. Oracle's another one, so let's do the two I vetted. Oracle, as you can see, has tight bid ask in here, good open interest. So let's go to the delta. So in Oracle, I was looking at let's look at the 39. So we'd buy two of the 39s and then go about 3 ticks out because it's close to, it's under the $50 strike. So that's about $3. Anything over the $50, I started looking at the $5. So $3 below would be if we do the 39s, it would be about the 36s. And then $3 above, 39 would give us the 42s. 36s didn't give me love. So we have a $3 wide butterfly. $3 wides is the wings. And then we're getting $1.67 for this strategy. So we're collecting more than 50% the width of the strike. So let's look at the analyze on this. And again, the reason why they call this a butterfly, if you think back to the other one, since we're doing two, the base is pretty heavy, and like a butterfly has big wings, so that was the idea of a butterfly. It kind of looks like a bird also, but a kid's bird, I suppose. But this is why we call it butterflies, because it was fat in the middle and had the long wings. So this, again, we're risking 167 to make, or sorry, our profit is 167 and we're risking 133. So we're risking less than we have the potential to make. So that makes that one. Is this directional? No, it's not directional. I said that I would like to lean towards the downside because I have a deep in the money. If it rallies, I start having a deep in the money call, which increases your assignment risk, but we don't care because, as you can see, our max profits achieved if we rally really hard to the upside, or max profits achieved if we tank. So the only thing we just don't want it to do is continue to stay right here where it's at. If you see it, if you use this during earnings, when would you take it, before or after the announcement? Great question, Trevor. If I did it before earnings, I probably wouldn't do this with an earnings cycle in it. But if I were to do it for an earning, and if I happen to do it before an earnings and it was profitable before that earnings, I'm taking it off. I'm not going through the announcement and risking that. If I did it for the earnings, then I would have to obviously wait for after it. Can you repeat what kind of condition is best for this strategy in case of Bank of America or Oracle, both earnings or no earnings? I wouldn't want earnings on this. Oracle doesn't have earnings, does it? No, so Oracle just had earnings. So I didn't look at when their earnings is, but they just had earnings. These next couple of months are likely to be clean, and they just had their dividend, so I don't have to worry about that. So it's pretty clean. One thing that I was talking about with Oracle, it's been trading in a tight range. It's kind of gotten complacent, really low implied volatility. With the market profile, people that were asking about market profile trading, it's going to want to go back to this area. That's where the most time and volume has been spent. Of course, it could start trickling, but my thinking is that Oracle is going to, have a rebound here and would go up or snap down. I don't care. If it gets below this area, it's really going to snap. These people that are trying to get long here are going to just puke. So I don't really care which way it goes, but I want it to snap out of this little range. Theta, any problems with theta decay? No, there's no real problems with theta decay because we're collecting a credit. We'd like to see that theta decay, but our real thing is we want to see a big move, because if it stays right where it's at, it's not going to work out. We're just going to lose the. How much time do you keep when you put this on? How much time do I hold this trade for? Well, for one thing, I don't like to take it into expiration, but it is a defined risk strategy. And if I've held on to it and it's not really working out, I'll usually, I know what my risk is going into it, so I'll kind of let it play out if it's really not working, and hopefully get maybe on the last day a big move or something like that. So if I put this trade on and it's not working out, then I'll probably be more likely to hold on to it. If, for instance, I put this trade on and I put this trade on here and we got this big move, even pretend it wasn't earnings or this here day, and got that big move, you're probably not going to be able to get 25% or 30% because volatility is going to have expanded and stuff like that. But if I got this big move right away, immediately, I would probably look to cover that trade if it happened right away. I'd cover it for any kind of profit that I got. I mean, because you beat the probabilities, right? That's the idea, is with this strategy, if you beat those probabilities, don't risk it anymore, because if you can beat the probabilities, why would you ever keep going with it? Probabilities are then way against you. So if it happened right away, then I would probably cover it, even if it wasn't quite 25% of max profit. That wouldn't necessarily be a hard rule in that situation. Beating the probabilities will usually supersede my max profit or my percent of max profit, right? Because ultimately what I'm doing is playing probabilities and putting rules around that. But if you beat the probabilities, you ever beat the probabilities, bam, take advantage of it. Because the probabilities will play out. You may beat the probabilities on this and it continued to get better and you would have been like, why didn't at the end of the day, if there was no major news here, then and I beat those probabilities, then I wouldn't probably hold on to it much longer. If it was a buyout, somebody said they're getting bought out for a certain price and it went past my upper wing, then I'd probably then or above or below those wings on a buyout rumor or something like that, then I might end up holding on to that a little bit longer, because especially on a buyout to the upside, you know exactly what price you're getting it. So does that make sense? I like 1 week or 2 weeks or more. If you're talking about this one for this type of strategy, it's really going to be dependent on playing those probabilities. Can you show Oracle chart is best or worst case scenario? Well, best case scenario for this trade, obviously we want it to just snap past our wing on that, and with the Oracle, our wing was the 36 to the downside. And the reason why I would like to go snap down below this 36 to the downside, or tank like it did, right here or right here, is because then I don't have as much risk on the table, because the likelihood of me getting assigned of those in the money short calls that are now closer to at the money is much lower than if it snapped way to the upside and somebody just was like, you know what, I want those calls right now. and you could have assignment risk. That's going to be your real risk. Rick says, attempting to run back and forth across a busy interstate highway. Absolutely. If you did it once, if you ran across and got through, you know, to pick up that quarter and you saw $1 on the other side, I'd probably just keep my $1 or keep my 25 cents. I wouldn't risk that 25 cents for the $1 across the street. All right. So that was a good one. Does anybody else have any other real quick questions before I move on? What was that? How much, sorry, so best breakout, not staying in tight range. Absolutely. We need a breakout with this one. So something like the rubber band's gotten wound tight and we're looking for a snap. You know, I mean, same thing could be like, you know, even if it's in a slow trend up, it has a tendency to snap one way or the other, because the bulls or the bears, you're looking for the bulls or the bears to get just kind of tired and worn out and somebody gives up. All right, so this is what we're doing. We're doing a premium membership trial for $7, 1 month for $7. The link is right there in the chat window. So if you pop open that link, not this questionnaire box, you're not going to see it there, but it's in the chat window. So you can go in there and see that link right there, how to get this premium membership offer for $7. I mean, I know I spent more than $7 in commissions today. I'm sure you guys did too. So for price of less than a day's commission, you guys get 1 month premium membership, which gives you access to just about everything. You get the daily market commentaries where I talk about like my IWM trade, my SPY straddle. I talk about how I turned a straddle, or sorry, a strangle that went bad into a straddle, rolled those puts up, made it into a straddle, rolled it out in time, and now I've created a scenario where I am right there at break even. And that may not seem very momentous, but you know, I'm short the 217 straddle, if you can imagine, and now I'm at break even with the SPY trading up here at what, 228. So you know, that is, you know, huge in that how to stay mechanical and create a bad scenario, turn it into a good scenario. So I talk about all that stuff in the daily market commentaries. I actually talk about that in the webinars as well. But one of the key things to get is those daily market commentaries, and pay attention. Watch those, you guys. I talk about the good, the bad, and the ugly. I'm not one of those guys that only talks about my good trades. As a matter of fact, you'll rarely even hear me talk about the good trades. Those are the ones that are in and out. I talk about the bad trades more than probably anybody else out there, because those are the ones you learn from. Those are the ones that will, you know, decimate your portfolio if you aren't mechanical, if you don't follow the rules and stay mechanical. Make sure you can turn those things around, because it works, and I show you how to do that. I mean, I go through it in the market commentaries. Not every trade works out, but you know, I talk about it, and I'm going to teach you guys how to work around that. You also get the option trading workshops, which is well over 50 videos now in that workshop. You also get priority access to the online options live trading workshops, which is what these webinars are. So some of the past ones that I've done, like the poor man's covered put, synthetic long, synthetic shorts. If you guys are trading with, you know, not a whole lot of money, or you're trading in an IRA, we've got all kinds of webinars out there on IRA appropriate ones. And we also have strategies that for the people that don't have a lot of money in their account, if you have like $25,000 or less, you probably shouldn't be going out and buying just stock and maybe selling a call against it to lower your basis. I show you different ways to increase your yield, increase your return on capital, and participate the same way as you would if you were just out there building a portfolio of stocks. So show you how to do all of that in those, and for $7 you cannot beat it. and you'll receive it for free. So if you guys want to, literally, you guys need to be trading with this knowledge. I mean, and especially if you've enjoyed my instruction, these webinars will really help you out. My regulars, I know are signed up for this. And if you want to trade like a floor trader, one thing that I've always said is the floor traders are the best guys to learn from, because they're going to tell you what their losers were and or are, and talk about trading around that. Who cares if somebody made a ton of money on one trade or whatever? That doesn't do you any good. The probabilities are not in your favor on that kind of strategy. The thing to do is learn how to turn a bad trade into a good trade, and that's what I do in all of these videos. I make sure that you know how to do that. And if you have any questions, our guys at the home office will be able to answer them, and if not, they send you over to me. And if you want to talk to me directly, I have a no inbox policy, and you get that with this as well. You can send me an email. This trade's not working out. What would you do? What are your parameters on this? What's your risk? I can't tell you what I think you should do. I can tell you what I think I would do, or what my rules are around that, because again, it goes back to me not knowing your portfolio and everything else, but I can give you the rules as to what I follow and how to stay mechanical. And this course, or all of these courses, all these classes are designed to produce consistent winners, because I talk about the probabilities, and if you're constantly playing the probabilities, they consistently will work out mathematically. So and this course could pay for itself in seriously one trade. All right, so check it out. Get in that chat window. This is also the link right here for that options class, or for that options subscription. You're gonna, if you're watching this later on, you're just gonna have to write it down. You can pause the video, write it down, and put it into your URL. I don't think there's an easy way to copy and paste it. And in later webinars, I'm going to be drilling down on options components, how to trade, when and where I find them appropriate. Also, want to thank you guys. If you have any questions, again, call us at 310-598-6677, or you can email us at trading@protraderstrategies.com. So write that down, but if you're participating in this live, the easiest thing to do is to click on that chat window, and for less than a Subway, you know, you guys can get a month free or a month of this stuff. Always enjoy. Thank you. Learned something new. Good. Thank you, Dan. Any adjustments to this trade, Trevor? One thing with defined risk strategies like this, I usually do not go and adjust these. Also, the URL's up here at the top, so you could copy that down. So I don't usually adjust this trade. It's usually kind of, that's why I'm trying to create a scenario where I am standing to win more than I have a probability of losing. So not really an opportunity to adjust this trade. You could look at rolling it out in time. If you're collecting a credit, that would be the way to do it. If you could roll this strategy out, if it wasn't working out, and still collect a credit, which is probably not likely, but if you could, then I would do that. I would not do it if I had to roll it out in time and collect a debit. In the case of 42 or 36, is mass profit, is earnings best on this strategy? Sophie, it tends to go extreme. If you're talking about with Microsoft on that one, was that on Microsoft that you're talking about, or was that on the Oracle? Well, I forget what the Microsoft strikes were. So Oracle was the 36 and 42. I don't. So with Oracle has a tendency to spike, then yeah, you could do it. But I mean, I would do the Oracle now. And as a matter of fact, you know, if you watch those daily market commentaries, one of those things, I usually throw on a couple of these on Monday that I have vetted. So I'm probably going to be looking at Target and Oracle on Monday to see if they still fit those parameters to put those on. So you can check that out also. Follow me on those daily market commentaries, because they're usually about 10 minutes long. I go through economic, geopolitical stuff, and then go through the markets and then talk about my trades, exactly trades I put on, the trades I take off, how I managed them, what my profit and loss on each one of those is. So actually, I just tell you what I paid for them and what I lost and or made. So, all right, did I answer everybody's questions? What time on Tuesday? Why are we off on Monday? Monday a holiday? Monday Martin Luther King? No, it's coming up. I don't know what you mean by, usually the market commentaries come out. I try and do them at around 11 o'clock Eastern, and it usually takes me, a half an hour or so to convert it, and it usually gets out around noon. Sometime between 11 and 1, I would say Eastern, for those market commentaries to come out. Depending on, because some days it's like a struggle to find good trades to put on, and I'm kind of like waiting for some of my trades to get hit before I do that, so that I can let you guys know and not have to tell you the next day. So usually it comes out sometime between 11 and 1 on Eastern time. So how does it help us if we only hear what you did after the fact? Well, that's the thing. That's why I'm trying to do it. Like in the morning, I'm doing these trades. Usually I put trades on in the morning. I mean, you're only going to miss like a penny or two, right? Sometimes actually even the next day it's better. So, who knows? But that's why I'm trying to get those out in the morning so you guys can hear what I've done beforehand. So, so you guys are ahead of it. Because I want you guys to be able to know when I did it, like as soon as possible. Does that answer your question, OM? So I'm trying to get it out to you as fast as I can and tell you exactly what I did, what I paid for it, and everything else. So yeah, I don't like it when it's at the end of the day and I get filled on something, and especially when it's the next day and, it would have gone against you or something. I don't like that, but it does have a tendency to happen. But again, on the other side, it's probably as probable that it went the other way. All right, that's all I got for you guys today. Everybody have a great weekend. And if you can't take that, take it easy. Thanks, Rick. Great seeing you back. I know I've seen a lot of people back, Sophie and several of you guys. Thank you guys. Thanks, OM, and I've seen you around too. Take care. Have a great weekend, everybody.